So what does the insurance and policy wording process look like in the London market? That's the key question that we'll be tackling at today's masterclass session. Thank you very much for joining and for listening in to the session. My name's Tom Hughes. I'm a senior underwriting and claims executive at the International Underwriting Association, and I'll be overseeing the event today. Now, I'm very pleased that we have three expert speakers with us who you will get to meet during the session. We have Effie Zachopoulou, who is a senior wordings counsel at Convex Insurance, Chelsie Mowling, who is an associate operations at Consilium Broking, and Christopher Crane, who is a legal director at Wikborg Rein, LLP. Now, this masterclass is part of our 2024 series. We have 4 sessions across the year that have been organised by the IUA's Clauses Committee. This is session 3. So you can see we've already had mastering risks and the scope of cover, unravelling claims, loss and resolution. And then here we are today at navigating the London market process. And we're nearly there. One more session, cracking reinsurance structures, which we'll be hosting in a few weeks' time. Now, the agenda for the session today is on screen. Our speakers are going to take us through a number of key topics. So we'll look at fair presentation in the Insurance Act, roles and obligations of parties, the subscription market, the MRC and contract certainty, the slip, and finally, bordereau and single claims presentations. Now, it's worth noting that we will be focusing today on the English law perspective. Of course, there is some application more broadly, and we might touch on it at times, but it makes sense for us to focus on English law. And then, of course, bear in mind that where different choice of law and jurisdictions are used, there may be different rules applying. Now, our wordings experts will provide their individual views and experience based on their experience and their wordings roles. They're not here to opine on any coverage or claims matters. So you will note we won't be doing anything like that. Now, a brief look at what is the IUA. Well, we have 81 member companies. There'll be lots of familiar names on the screen, and they are ultimately insurers and reinsurers who are active in the company market in London. One of our roles is to publish model clauses and wordings, and the obvious question is, why do we bother doing so? And there are a number of different reasons, but primarily it's due to member demand. And that could be for a range of reasons. So emerging risks, new legislation, perceived inadequacy in existing clauses, or to provide alternative or new coverage options. That won't stop individual insurers and brokers from doing what they've always done and developing their own provisions. But we have a committee that brings together experts to draft model template clauses and wordings. Now, they can then be taken on by market practitioners and used in their entirety as drafted, or they can be amended or actually ignored altogether and not used. The committee itself, it's the central drafting function within the IUA committee structure. So any clause or wording that has an IUA code on will have been ratified and published by the IUA's Clauses Committee. Now, on screen, you can see various clauses and wordings that have been published, and that's across all classes of business. So most recently, we published a capitalization clause more specific to the casualty world, but elsewhere on screen, we've got a financial interest clause, for example, that is very much cross-class in nature. We do have broking representatives on the group alongside the 26 IUA member insurers and reinsurers, and that's incredibly helpful to get some commercial reality, some feedback during the drafting process, and that's really important to us. And we do often informally consult with external stakeholders. Now, we have one legal representative, Christopher Crane, who you'll meet during this session. And as a group, we have been spending time focusing on the risk manager community and making sure that we are liaising as best as possible, normally via AIRMIC as the representative association. All of these clauses can be found online at the IUA's clauses library. They're freely accessible and they're searchable. And not only will you find IUA clauses on there, you will find some joint marine and aviation clauses that are published by joint IUA and LMA, Lloyd's Market Association, in collaboration. Now, with that, we will move on to section 1. I think Effie will take control at this point, and we will go from there with the pre-inception stage. Thank you, Effie.
Thank you, Tom, sorry. I'm going to go through the pre-inception stage, and I will start with a bit of history on insurance. The London market is one of the largest hubs of direct insurance and reinsurance. And from a basic definition of insurance, it is a means of protection. It's a transfer of risk in which, in exchange for a fee, a party agrees to compensate another party in the event of a loss, damage, or an injury. So this business that provides this, the insurance, does that by providing the individual or business involved with an insurance contract, sometimes called a policy. And the policy holders can be businesses, they can be organizations, they can be other insurers, and they can be individuals. And policyholders can access the London market via a broker, a cover holder, or service company. Our main focus today will be brokers who facilitate this risk transfer process between policyholders and underwriters. And most of this process involves face-to-face negotiations between the different parties. Now, the complex nature of the London market has led to the development of a very sort of sophisticated risk sharing model, which is the subscription model, and which basically means that each London market underwriter will take a portion of the risk, not the whole amount. And although much of what I'm going to be discussed focuses on a number of few parties being involved, there's a sophisticated distribution model in the London market on which Chris is going to go on more detail. And it's worth also saying that this presentation will focus mostly on open market business, where the risk is presented individually by the broker to a number of different underwriters. Now, again, going back to the sort of the London market, what is being used is the market reform contract to document insurance contracts. This is going to be what Chelsie goes into more detail, but it's important to note that one of the aims is to ensure that the contract terms are clear and unambiguous by the time the offer is made to go into the insurance contract or is accepted. And a very key principle that underpins the dealings from both sides is one which is a fundamental one in insurance contract law, the principle of utmost good faith. It basically states that, you know, the both parties involved in the insurance contract must act in good faith towards each other, and that they both must provide clear and concise information regarding the terms and conditions of the contract. Now, even going back to history, in marine insurance, the underwriters often were unable to check the ship or cargo because they were at sea. A lot of faith was put into the statements of the ship owner or the owner of the cargo. So utmost good faith is not just honesty. It includes notions of openness, of fairness, reasonableness, and basically these lack of that undermines the very foundation of the contract. So it's important to see now, how is this objective of good faith achieved at the pre-contractual stage? Well, one of the main principles is the duty of disclosure. Now, I will focus, as Tom said, the focus will be under English law. The old law is as found under the Marine Insurance Act of 1906. I'm saying old law because part of the Marine Insurance Act have been overtaken by the Insurance Act 2015. But originally, under the Marine Insurance Act, the insured was obliged to disclose all material circumstances that it knew or ought to have known in the ordinary course of its business, and not to make a representation to the insurer. And in order for an underwriter to rely on a non-disclosure or misrepresentation, they must have been induced by that to write the risk. Now, the remedies for any breaches of the duty under the old law was only avoidance. So it was quite severe, where an insured had made a non-disclosure misrepresentation, the insurer was entitled to basically avoid the policy ab initio and basically treat it as it had never been existed, as it never had existed, with a refund of the premium. Now, the Insurance Act 2015 changed not so much the duty, but mostly the remedies. And it's important to state here that there's a difference between consumers, non-consumers in terms of the duty. For non-consumers, the duty is very much similar to how it used to be, but the remedies are different. They're much more they're now proportionate remedies, and it's important that we sort of distinguish between the remedies under the Insurance Act 2015. If the insured acted deliberately or recklessly in breaching the duty of fair presentation, the insurers are entitled to avoid the policy from inception, retain the premium, and refuse to pay any claim. If it had been not a deliberate or reckless non-disclosure or misrepresentation, then the remedy will depend on what the insurer would have done if the proper representation would have been made. If they would not have written the risk at all, they may avoid the policy and refuse all claims, but they must return the premium. And if they would have written the risk, but on different terms, say it would have included an exclusion or a different premium, then the policy will be treated as if those terms had been included from the outset. So a particular exclusion was in play, or if they would have charged, the insurer would have charged double the premium, then it can pay 50% of the claims. Deliberate or reckless is that the insured either knows that the misrepresentation is untrue or misleading, or does not care whether it is, and knows that what is misrepresented is relevant to the insurer, or does not care whether it is or not. And that is something very important. It's something for the insurer to prove. I've put, I'm not going to go into too much detail, but it's important to point out that for the consumers, the duty is slightly different in that it's a duty to take reasonable care not to make a misrepresentation, but there's no duty to volunteer information, which is different to the duty of fair presentation, where there is such a a requirement. And then the remedies for consumers pretty much mirror the remedies for the non-consumers. Just go to the next slide. And when is it important to disclose? Now, the duty of fair presentation arises before the policy is placed, so pre-inception. It applies throughout the negotiation before the insurer agrees to accept the risk and set the terms. So it's up and until the contract is entered into. Now, again, at any variation, alteration, or extension, for example, when there is an endorsement, at renewal, so it's the duty to make a fair presentation and declare any changes to the risk or disclose any new material facts arises again at the renewal. And there may be a continuing duty of disclosure. Now, there are a couple of situations where this might be the case. The first one is when, during the length of the insurance contract, there is an agreed change, or if there's an express contractual provision. Sometimes these are stated as increase in risk or alteration in risk clauses, and which state that any material facts during the term of the policy must be disclosed. And what is that needs to be disclosed? So disclosure is required for every material circumstance which the policyholder knows or ought to know, and the Act provides quite a lot of detail. For example, it does state that a circumstance is material if it would influence the judgment of a prudent insurer in determining whether to take the risk, and if so, on what terms. So it's a matter of what would be relevant that impacts on the decision-making process. And again, there are some examples given under the Act of what might be a material circumstance. For example, special or unusual facts about the risk, any particular concerns that the policyholder has, and that's why they're looking to buy insurance, a change, anything which affects, a change in the geography, a change in the products, new acquisitions, new premises, and basically anything which those concerned with a class of insurance and field of activity in question would generally understand as being something that should be dealt in with a fair presentation of risks of the type in question. So it's quite a wide sort of example. Now, it does sound like a very burdensome sort of duty, and that is the case. It would be useful to give you an example here of a case which was the first judgment on the duty of fair presentation, Berkshire Assets and AXA, where there was a physical damage and business interruption policy. The renewal was in November 2019. In August 2019, criminal charges had been filed against one of the insured's directors. These charges were ultimately dropped a year later, but when Berkshire made a claim against AXA, AXA said that had they been made aware of those charges, they would not have agreed to insure Berkshire at all, and therefore they were entitled to avoid the policy and not cover the claim. And the High Court was asked to determine whether the criminal charges were actually a material circumstance. The court did provide some very useful guidance on what is material. So whether a fact is material is a question of facts and had to be determined on a case-by-case basis. Materiality is at time of renewal. That's when it's important. So the prudent insurer test that we mentioned before is assessed principally from the perspective of the insurer. And it doesn't matter that a circumstance, it doesn't need to be decisive, the decisive one. It's just sufficient that it's a circumstance that the underwriter would have taken into account. And of course, it's not just important, again, it's important to stress that it's not just enough that something is material. The insurer needs to show that it was induced. They relied on that they wouldn't have entered into the contracts had they known of that particular circumstance. And overall, the duty sounds like a heavy burden, but there are some points in the Insurance Act, for example, that if sufficient information is given, then the duty will be satisfied. So it's sufficient information to put a prudent insurer on notice that it needs to make further inquiries. And it's also important to state that there are certain circumstances, and again, sort of useful outline in the Act, that don't need to be disclosed. That is mainly circumstances that diminish the risk, circumstances that are already known by the insurer, and insurer means everybody involved in the decision-making process of writing the risk. Facts that ought to be known by the insurer, and it's difficult to kind of like provide definitive points on what it is, but the act does state that employees of an insurer must pass knowledge to the relevant underwriters of that is held within the company. Facts that the insurer is presumed to know, and for example, things which are common knowledge. And lastly, things which may have been waived by the insurers. There are two cases which are very interesting, discussing whether it is possible to have an implied waiver. It's Young and Royal Sun Alliance and Ristorante against Zurich Insurance. They seem to be contradictory because on one the insurer prevailed, on the other one the insured. But actually, both cases do stress the importance of clear drafting, and they have to do with how questions are posed on prop forms. And the conclusion really for both is that where a question, where the wording of a question imposed by the insurers is ambiguous, it will be resolved in favor of the insured, so long as the insured's interpretation of the question is reasonable, objectively reasonable. And on my last slide, who does the duty apply to? It's where the policyholder is an individual, it is the themselves and any person who is involved in procuring the insurance for them. Where the policyholder is a company, what needs to be disclosed is what is known by its senior management. And senior management is again defined by the Act as those individuals who play significant roles in the making of decision about how the insured's activities are to be managed or organized. There is an LMA clause that can be used to define specifically for a particular insured who the senior management might be. And where the policyholder is a company, it's also the duty applies to the persons within the business who are responsible for the insurance procurement, and it can be risk managers, employees, agents, brokers, and the ought to know is what should reasonably have been revealed by a reasonable search of information available to the insured. And that includes information held outside the company, held by agents, for example, accountants. And it's important to stress that reasonableness is not a fixed concept. It really depends on the kind of the circumstances of each risk of each sort of company, and a reasonable search needs to be proportionate to the type of insurance, to the size of the company, the complexity of the risk, and it is also very important to make sure that the search is documented so that there is that sort of paper trail in case there's ever a dispute. And it's not, going back to one of the points, it's not just actual knowledge. A policyholder cannot go around and say, you cannot circumvent the duty of fair presentation by failing to investigate something that's seemed like, there might become a material circumstance. And because the Act covers not just actual knowledge, but matters which someone suspected and would have had knowledge, but for deliberately refraining from confirming or inquiring about those matters. So that's quite an important factor in the duty of fair presentation. And finally, the ABN AMRO and RSA case is a very interesting case that sort of touches upon most of the things that I went through. And I'll go very quickly on that. It was a £35 million claim, where the claim was for a credit risk cover, which was provided under this unusual and unprecedented clause that had been added by endorsement to an all risks marine cargo policy. It had been drafted, it was a bespoke clause, it had been drafted by lawyers, it had been scratched only by the leader midway through the previous year's policy. And at the same time, a non-avoidance clause had been added to the wording. Now, the insurers argued a number of misrepresentations and non-disclosures to decline cover, but these arguments were rejected by the High Court, and actually the case went to the Court of Appeal, and again the insurer actually prevailed. It has a number of interesting points, but the kind of like the overall guidance, which is relevant to all lines of business, is that when considering the language used of the clause, the court always looks at the what the reasonable person who has access to the background and knowledge of available to the parties at the time of contracting, what would they have considered is meant by that language. Now, subjective intention of the parties cannot be taken into account, save in a very unusual case, the meaning of a clause will be taken to be the natural meaning of the language. Clear language prevails over arguments of what would have made commercial sense. And basically, when the language is clear, the court will not alter the interpretation of a clause simply because it was a bad deal for the parties. And it overall, both this case and the Berkshire and AXA case placed a lot of importance on underwriting notes and contemporaneous notes of what was presented at the time. And I think that's where I would stop and leave it for Chris to take over.
Thanks, Effie. So Effie has really outlined there how the duty of good faith and fair presentation are fundamental to the placement of insurance. I will now look at some particular aspects of the placing process and contract formation in the London market specifically. And when I was preparing for this presentation, I came across this rather stark remark by a Court of Appeal judge who said that understanding the contractual procedures of the insurance market does not come easily to those who are unfamiliar with it. And indeed, the hearing of the present appeal induces me to believe that even amongst those very much more experienced than I, there remains room for a considerable degree of uncertainty. So this rather damning remark was made in 1983 and highlighted the inherent uncertainty in the placement process. At that time, the market often operated in a very informal way, the so-called deal now, detail later culture, which gave rise to an extraordinary range of disputes about all sorts of placement issues, including whether or not the policy was formed, when it was formed, what the terms were, what the extent of the underwriter's liability were, whether the policy changes took effect, who was responsible for presentation information, and so on, and so on, and so on. Thankfully, there have been significant improvements since then, largely as a result of market initiatives in relation to contract certainty, starting in the early 2000s, and that Chelsie is going to discuss in a short moment. That said, so many of the issues that previously arose in the placing process have now been stopped at source, or at least significantly reined in, by the simple overriding principle that all terms of the contract must be clear and unambiguous by the time the contract is entered into. That said, it remains the case that placing in the London market can be a complex process which involves different rights and responsibilities for different parties depending on where they sit in the arrangement. The key message from me is that it's up to each party to take responsibility for identifying and the information that they need to make an underwriting decision and who is responsible for providing it. In that context, I'm going to focus on two key areas of the London market. First, brokers or other intermediaries are almost always involved in placement. And second, the London market is a subscription market where large risks are invariably written by a number of co-insurers. So this diagram is my attempt to show in a simplistic form how risks can flow through different channels in the placing and underwriting process. We have policyholders at the top, brokers and other intermediaries in the middle, and insurers and reinsurers at the bottom. In the most straightforward case, the assured will engage a broker to act as its agent to place the risk. Where the risk is placed in the subscription market, the broker will select a leading underwriter that has a reputation as an expert and whose lead is likely to be followed. The broker will present the risk to the underwriter, and they will then negotiate and finalize terms. When the terms are agreed, the leader will then subscribe to a percentage of that risk. The broker will then present the risk to the following market, underwriters and secure further subscriptions until the risk is fully subscribed. In the old days, this was done by the broker taking a physical slip which contained the basic terms around the market, and each underwriter scratching the slip with their percentage participation. The broker would then prepare and issue a full policy once the wording had been approved by the leading underwriter. It was therefore a two-stage process, the slip followed by the formal policy wording. Nowadays, because all terms must be clear and unambiguous when the contract is entered into, the two-stage process has been replaced by a single stage. Now, at the outset, brokers must prepare policy wording in the form of the market reform contract, and it is the MRC that is presented to underwriters to scratch. It's worth pausing here just for a moment to clarify some language that can be confusing. People often still refer to the slip when really it might be more accurate to refer to the MRC. So as well as the primary insurance, there may be layers of reinsurance, and those layers may also be written on a subscription basis. The beauty of this is that it allows large risks that can't be underwritten by a single insurer to be placed where the risk spread across many underwriters who can each participate at different levels according to their appetite. I won't say too much more about the reinsurance part, as this is for the topic for the next session, apart from to point out that if a broker places both the primary and the reinsurance layers, they will then be acting in different capacities. First as the agent for the insured, and then as the agent for the reinsured. Now back to the broking section of the diagram, it's not unusual for there to be more than one broker in the chain. In many cases, there'll be a producing or retail broker who interacts directly with the insured. They are responsible for understanding their clients' insurance needs, providing advice, and finding suitable insurance coverage. They handle the relationship with the client and gather all the necessary information for the presentation of the risk. But they may appoint a placing or a wholesale broker who's able to leverage their market knowledge and relationships with insurers to secure the best possible coverage. Although this relationship and arrangement does not usually give rise to any particular issues, it's not difficult to see that tricky questions could come up in connection with the fair presentation of a risk if one broker, but not the other, is aware of material facts. Whether or not that information needs to be disclosed will depend on whether it's deemed to be information that the insured knows or ought to know. The last link in the diagram is where the risk is placed through a managing agent or a cover holder. Managing agents are specialized intermediaries who are authorized by insurers to perform certain functions such as underwriting and binding coverage. So unlike normal brokers, they therefore act as agents for the insurers. However, the general rule is that the broker acts as the agent for the insured, and this comes with a range of duties that it owes to its client. In the context of placement, the broker's most important duties are to perform its client's instructions in a timely manner, exercise reasonable care and skill in placing cover, avoid conflicts of interest, and make a fair presentation of risk as agent for the assured. In practice, brokers and underwriters often have close commercial relationships. These help the markets to run efficiently and can mean that brokers are able to leverage their relationships to place business that might otherwise be difficult to place and secure prompt payment of challenging claims. However, where there are complex broking and placing arrangements, it can be worthwhile for all parties involved to just take a moment to make sure that they are clear in what capacities they and others are acting in and in whose interests they are acting for. I've already mentioned that managing agents and cover holders are in fact agents of the insurer, but there may be other circumstances where a broker may assume a duty to insurers. For example, where a broker places both the primary and reinsurance layers of a risk, or when in placing a risk, a broker gives express assurances to an insurer about particular aspects of how the risk will be placed. So to sum up, the key things to keep in mind at placement are who's responsible for providing the information, in what capacity has the information been provided, and on what basis can the information be relied upon. Turning now to some of the key features and mechanics of subscription market policies. A key feature of subscription policies is that each subscribing underwriter enters into a separate contract by scratching the MRC. Each underwriter will be bound when they scratch the MRC and not at a later date when the MRC is fully subscribed. As each subscription creates a separate contract, each subscriber is only liable to the amount of their own subscription, and they're not responsible to pay the claims of other subscribers. This is expressly recorded in the security details section of the MRC. Another aspect is that it's not unusual for brokers to obtain more than 100% subscription on a slip in order to get the best possible coverage for their client. The broker will then sign down the written lines so that coverage is reduced to the 100%. The broker may therefore give insurers a signing indication of the likely reduction so that insurers can write their lines accordingly. Alternatively, the insurers can specify that their written line is to stand, which means that it will be allocated in full. The market practice of signing down is so established that there are mandatory signing provisions in the security details section of the MRC contract, which require the parties to specify the basis on which each insurer's final participation will be determined. So the lead underwriter obviously plays an important role in the subscription market, and following insurers will often rely on the leader's expertise and judgment in underwriting the risk. This has led to questions as to whether the leader owes duties to the following market. The clear answer to this is that there's no duty as regards the initial underwriting, although there may well be later on if and when the leader agrees amendments or settles claims on behalf of the following market. That said, there may be particular circumstances or arrangements, such as in the case of line slips, where the following market insurers delegate underwriting authority to the leader, which then impose a duty on the leader to carry out those functions with reasonable skill and care. Another question that arises is if there is a misrepresentation to the leader that entitles the leader to a void, but the same misrepresentation is not repeated to the other followers, are the other followers also entitled to a void? So the answer to this is not straightforward, but the best view seems to be that the fact that a misrepresentation has been made to the leader is itself a material fact that should have been disclosed to the followers, and non-disclosure of this fact therefore entitles the followers to a void. So I've mentioned contract certainty and the market reform contract quite a few times, and Chelsie will shortly talk a little bit more about this. But before I do pass over to her, I just wanted to draw your attention to the subscription agreement in section 4 of the MRC. Among other things, the subscription agreement identifies the slip leader and specifies the basis of agreement for post-placement changes to the contract. Very often, this section will refer to and incorporate the General Underwriter Agreement, or GUA. The GUA is a standardized form of leading underwriter clause and sets a framework for establishing contract changes that the leader can agree alone on behalf of all insurers, which will usually be limited to quite minor changes such as correcting typo errors in the wording, changes that can be made by the slip leader together with named agreement parties, and changes that must be agreed by all contract parties, which will usually include changes that increase the insurer's potential exposure. Although these provisions are administrative in nature, they do have important implications, so insurers should consider them carefully when they underwrite the risk to make sure that they reflect their intentions. And so with that, I will hand over to Chelsie, who will look more closely at the MRC.
Thanks, Chris. Just move on to the MRC. Okay, so I'm going to be looking at post-bind and claims stage, which is the MRC, and then some of the terms that you will commonly see within that contract. So I'm going to start with a little bit of history and just show you sort of what slips used to look like and what we're now used to seeing every day in the market. So the one on the left is a slip from 1944 for homeowners insurance, and the one on the right is just the example that is currently given out to the market when developing the MRC V3. So I haven't been able to give you the entire document, but there are some things that are still very common. So you've got your conditions, exclusions, your period of cover, and the Lloyd's button stamp. So I wanted to show you where we've been and where we're at, to then take you through a bit of a timeline about why we have changed so much. So I'm not going to go back to 1944 because that is a long time ago. So we started 1986, which is again still quite a long time ago. But we had the start of market reform in the Lloyd's market. So we had the Lloyd's A4 slip, and this developed and went through 9 changes up until 2023/2024 when we adopted the market reform contract V3 following its initial iteration in 2007. Sorry, 2006 is a slip. It's slightly different if we go back to Chris's point about slip and contract. So we've developed a lot since then, and there's been a lot of change, and it's all to do with driving the change that's required in the market. So we are reacting to issues we've seen in the market. As Chris mentioned earlier, we have obviously seen the lack of clarity between terms. We've seen that there's been a lack of consistency in documentation, and we've landed on the market reform contract as the most generic baseline contract that we can use in the industry to capture all the terms that we need. So why the market reform contract continued? So before I quickly go through it, I will just say the MRC does not cover anything to do with delegated authority. So no binding authorities, no line slips, and doesn't cover proportional treaty at this time. So the market reform contract was developed to drive market reform, to drive us to change as we react to the issues within the market. It helped contract certainty. So we had the introduction of the Contract Certainty Code of Practice, which was all about ensuring that parties knew the terms that they were entering into at the time the contract was bound, so we could avoid those issues of the deal now, detail later mantra that all of us are quite used to seeing, or at least hearing about in our time in the market. Consistency, it is a big drive on the consistency of the data we capture and provides the minimum data that we need to capture to make a contract certain. So it's much more commonplace across the market now that all information is captured in the same way, and this will start to drive the fourth reason for the MRC, which is future-proofing of data. So we're in a massive time in the market where we're adopting lots of systems and applications. We're doing big projects on data in the market to pave way for the new marketplace of digital underwriting, AI, and all other sorts of things to assist with our day-to-day job. So I'm not going to focus too much on every single part of the MRC because we could be here for hours. So I'm going to look at a couple of things that have already been touched upon by Chris and Effie. And we're going to stick with sort of the contract certainty bits and the subscription agreement. So one of the most common headings, which you can find on page 108 of MRC V3 guidance, is the reinsurer contract documentation. So this is a legit heading that I've come across. which reads as, this market reform contract details the contract terms entered by the reinsurers and constitutes the contract document. A claim is presented to insurers and based on the coverage within the final policy issued shortly after terms are agreed. There's a difference in the limits of liability. What takes precedence in the claim? So if you think back to what you've heard earlier in this presentation, you'll have to think about the two-stage process becoming the one-stage process, and the slip versus the MRC, and the slip versus the policy. So the answer to the question was a bit divided. I couldn't give you a firm answer, and I think the market is pretty divided in this, as we've seen. So there was not enough information for anyone to make a solid decision. There's lots of case precedent about slip versus policy. And as Chris said, we've now moved on to that one-stage process. But what does that really look like, and how has it been taken up in the market? So we're going to talk a bit more about the MRC slip versus policy. So you've got the market reform contract, standardized document used during negotiation between brokers and insurers or reinsurers, sets out the key terms, conditions and coverage, and assists with the subscription markets and keeps everything clear and organized. Your policy, in turn, is the final legally binding document. It officially confirms coverage and all terms, including exclusions or special conditions. The insurer and the insured refer to the policy for definitive terms. Now, that was the old school two-stage process. So simply put, you could say the market reform contract is used to work out the details of the deal, and the policy is the final contract once everything has been agreed. However, as per the scenario and as per everything we've heard in this presentation, it is commonplace in the London market that MRCs and policy wordings are combined documents. So what should that look like? Well, everything we used to do in our policies and our MRCs is now merged into one. So we would capture the quantitative data and the qualitative data side by side, rather than that separate MRC slip capturing your black and white figures and the final policy having all the detail. Again, eliminating that deal now, detail later element of placement. So an example of this is a quantitative is the ISO currency code and the value, so the limits or the sum insured. And your qualitative is the understanding of how that applies to the limit in the eventuality of a claim. So doing some further reading of that heading in your MRC is crucial in understanding what takes precedent in a claim and how it should be written. So whilst it's commonplace in the London market that MRCs and policy wordings are combined documents nowadays, it does not mean that is how it is being written down and captured on those documents. So the heading we saw earlier did not reflect a one-stage process. It reflected a two-stage process because it didn't refer to a policy at all. It referred to the MRC contract, which in case law is usually a different contract compared to your final policy. So we'll come away from the legal part of the MRC versus slip, and we're going to talk a bit more about subscription agreements. So as we've heard earlier, subscription agreements have become a lot more commonplace. It allows insurers to take a small portion of a large risk and still be part of it without all the issues of large claims. So they have to put a lot of trust in the leader. And obviously we touched on the general underwriters agreement, but as well as that, there's also SCAP or single claims agreement parties. So this was introduced to delegate a lot of the claims responsibility, and it's relevant to non-complex claims up to the value of GBP 250,000 or currency equivalent. It was introduced to streamline the process like the general underwriters agreement. Subscription markets have become commonplace, but it doesn't mean that obviously we want every single insurer having to agree every single little piece of information and share. So what does it look like in your MRC? So it's common that you'll see the LMA 9150 clause, single claims agreement parties clause, referenced in your MRC as a standalone heading with no detail underneath. I implore anyone to actually read the heading to understand how the clause works and understand that it's what portion of that claim is relevant to your MRC when understanding the scope of SCAP to that MRC. So, which is further explained in my next scenario. So we have two scenarios. You have scenario one. So the MRC contract covers 20% of $1 million loss. It is the claim in scope for SCAP. So if we think about what we just said, in really reading and understanding that clause to your MRC, the claim is in scope for SCAP. So it's not the amount of the claim in total, it's the amount of the claim attributable to that MRC contract. So a little bit of maths is 20% of a $1 million loss is 200,000. We'll assume that the rate of exchange does not go above 250,000 GBP, which would mean that the claim is in scope for SCAP. And your scenario two, a little bit more complex, but again, it's a good illustration of how you apply SCAP to the MRC and not the claim as a total. An excess program with the following layers written under two MRC slips. Layer one, you've got 250,000 in excess of 250,000. And you've got layer two, 500,000 in excess of 500,000. Total loss from the ground up is 700,000. For which policy is the claim in scope for SCAP? So the claim is actually in scope for SCAP on both layers. So after the deduction of the 250,000 excess, you have a $450,000 pound claim, to apply to each MRC. So 250,000 would then become covered by layer one, and the additional 200,000 left over would then fall into layer two, both within the limits of SCAP, assuming there are non-complex claims. So non-complex claims in SCAP are quite hard to understand, and it's all to do with really the internal risk controls. So SCAP guidelines and bulletins available on the market do detail what a complex claim is, and it's usually to do with things such as fraud and negligence and things like that. But again, it's always dependent on the individual company's risk controls and what they deem to be negligent or fraudulent, and it's their burden to prove as such. So what next from all that information? So I implore anyone in the business to be inquisitive about what you're using every day. We use MRCs every day. We say the word slip every day, and we say the word policy every day. And we don't do enough to understand what that means in practice. And we're not lawyers, but it's always good to understand what it does mean in terms of the law, because we are selling things to insurers of all natures, consumers all the way through to large insured companies. And I think it's important to think about the individual contracts. As we saw with SCAP, and as we've seen throughout this entire presentation, it's all to do with that final slip, the contract certainty of that slip, how things apply, how the markets are going to cover certain aspects, and ensuring the insured understands the cover they are entitled to. And lastly, think about the scenarios and information you've heard today. How will the MRC close the gaps in interpretation between insurers, brokers, and clients? So we've touched a lot on the two-stage process, and that one heading, again, referenced on 108 of MRC V3 guidance, is an important one. It closes the gap just that ever so slightly on what takes precedent, on what has the definitive terms, and will ensure that insurers, brokers, and clients are all referring to the same documents to understand what their coverage is at time of a claim. It will also improve the consistency throughout the market. So no matter who you trade with, you should be able to find the information in similar places, in similar formats, and this should really reduce confusion. So I'm going to pass back to Tom to finish off. Thank you.
Okay, thank you very much, Chelsie, and thanks also to Effie and to Chris for a really helpful session today. It's great to have this third session available, of course, on the IUA YouTube channel, and do go and check out sessions 1 and 2 if you haven't done so just yet. We're hoping that the set combined will be a really helpful resource. Now, as I said, watch out for that session 4, which we'll also be posting in the next few weeks. And really importantly, as Chelsie suggested, be inquisitive and do feel free to ask questions of us. So you can see there my email address. Very happy to pass questions on to our experts and then come back with some responses. We certainly have a few to get through from the in-person session. So with that, thank you for taking the time to watch. Thank you again to Chelsie, Effie and Chris, and we look forward to seeing everyone at some point soon.